It's a big week for global economies tied to the dollar. The US Federal Reserve is meeting this week, and it is widely expected to cut interest rates. If that happens, it'll mark a major shift this year as the American Central Bank held its key interest rates steady for 9 months. This might sound like a technical move only Wall Street cares about, but here's the thing: it's a signal of how the Fed views the health of the economy and where it thinks things are heading. It also heavily affects Gulf countries like Saudi Arabia, the UAE, and Bahrain, whose currencies are tied to the dollar. We're talking about ripple effects on oil markets, still the backbone of government revenues, and on how sovereign wealth funds allocate capital to fuel diversification plans. It also directly affects you as a consumer. Cutting interest rates means it'll be cheaper to borrow, whether to buy a car, a home, or use your credit card. But it can also mean lower returns on savings. And history tells us something else. A series of rate cuts have often been recognized as early warning signs of a slowdown, and sometimes a recession. So, as you can probably tell, this Fed decision could be an important one, and one that Gulf countries will have to follow, whether it fits their local economy or not. We'll explore this and more on this episode of Business Extra. I'm your host, Salim Essaid. Joining us today is James Swanston, a senior economist at Capital Economics who specializes in the Middle East and North Africa and knows exactly how global shifts from Fed rate moves to oil prices could ripple through the region's economies. James, thanks for joining us today.
Thanks for having me.
So, can you start us off by explaining what interest rates are and why consumers should care about this?
Yes, so interest rates are the monetary policy tool of central banks across the world. They're setting the rate at which consumers and investors can lend and or borrow from financial markets, from banks. And these are the sort of base rates that are set in these policy decisions. And they are sort of, I guess, the factor when it comes to numerous economies of how they control inflation as well.
And can you explain as well, why do interest rates set by the Fed in the US affect monetary policy in the Gulf?
Yeah, so the reason why the Fed policy matters so much for the monetary policy across the Gulf is by virtue of their dollar pegs that all these economies are tied to. So it's a bit of economic theory in terms of what drives that, but essentially it's that because of the dollar peg, they have to follow US monetary policy one for one, or there could be larger shifts in capital flows through these economies that could put pegs under pressure. So that is why they have to follow the Fed in a sort of one for one decision.
And going back to the consumer who's listening to this podcast, can you describe kind of in the day-to-day of like what to expect? For example, if there is an interest rate cut on Wednesday, as a result, what can people in the Gulf on the consumer level experience day-to-day, and kind of what's the timeline for that?
So in terms of the effects, how it'll feed through is, the central bank of any of the Gulf economies, so Central Bank of the UAE, for example, will announce their interest rate decision, and that will probably set a precedent in terms of how that feeds through into financial markets, what banks set their interest rates at. But that will take time to feed through. There was normally a lag to this of how it fully feeds through. That can vary from economy to economy, but there will be some immediate impact. But I'd say the full impact where any sort of move is fully reflected will probably take sort of somewhere between 6 to 12 months of how that fully feeds through into the economy. But that fundamentally will mean that the cost of borrowing comes down in the UAE, the cost of saving comes down. So there's a greater incentive to borrow from banks. Things like mortgages, for example, personal loans, they become cheaper, but also then from a saving perspective of the return they would get on their savings comes down as well. So there's a greater incentive to spend your money and have it outside of financial institutions.
Great. So we can see this as an initial step in the next 6 to 12 months, affecting any type of borrowing, from credit cards to buying a home or a car. So I want to ask you specifics going down the list, but let's start on the macro side. With Gulf states financing massive infrastructure and diversification projects, how does borrowing costs shape fiscal policy and debt management across the region?
So with regards to the investment from the government side of things, there'll be two sides of the coin. One is from the domestic side. If any of the governments are borrowing direct from the banking sector, which does happen, so their borrowing costs will come down from that side of things. But also, if they are seeking to also raise capital when it comes to go to international debt markets and also through in domestic debt markets as well, that sort of base level of interest rates will come down. It won't come down to probably the full extent of the sort of, say, if the Fed is to cut by 25 basis points this week, that it won't mean that categorically every interest rate that they borrow at will be at 25 basis points lower when they issue debt. But inevitably, it will mean that those borrowing costs come down. And obviously, if they are issuing international debt, say in the US, that's going to be reflective of Fed policy and then not any sort of risk premium on top of that. So it will mean that borrowing costs on the whole for governments is lower. I guess the degree to which they're going to go and issue debt and try and be capitalizing on lower borrowing costs will vary depending on their needs. For example, Saudi Arabia has much grander, larger plans in terms of its investment and diversification goals surrounding Vision 2030. It's been very active on the debt market so far this year. But by comparison, some of the smaller Gulf states where they're trying to contain debt ratios, for example, places like Oman, Bahrain, they're less inclined to probably go and issue new debts because they're trying to keep their debt trajectories on a more stable footing.
So if this is like last year where there were multiple interest rate cuts after the first one that took place in September last year, could we see, for example, more, as you said, investment in diversification projects and overall from Gulf countries investing in these like mega cities to economic development plans and to see faster growth in that area?
I think there's probably a bit more upside to that if we are to see sort of further monetary easing beyond just this meeting and over the next year. The counter to that is that we are against the backdrop of lower oil prices. So fundamentally that we have seen budget balances across the Gulf states deteriorate over the past sort of 12 to 18 months to a point where the emphasis on fiscal consolidation has come through. I think that's most seen in Saudi Arabia, for example. We've seen a big cut in terms of capital expenditure so far this year in terms of the public finances. There's been wider reports around cuts to giga project spending and sort of recalibration of sort of where they want to most allocate those resources. But if on the same sign of they are able to borrow money more cheaply and they see that as another way of investing into those sort of projects without having to spend new money, as it were, in terms of actual direct government spending, that might be a more palatable way for them to do so, that they see this as sort of a cheap way of financing that spending now in order to sort of push on with those diversification goals.
Okay, now let's shift to the consumer side. Can the Gulf actually see lower borrowing costs on mortgages, car loans, or credit cards when the Fed starts to cut rates? Or do banks tend to hold back on those benefits?
From the data we're privy to, it does feed through. We have seen sort of when there's been periods of, well, either side of the coin of if there's been interest rate hikes in the US or interest rate cuts, it has been reflective of periods in the Gulf where lending growth has tended to move in the sort of the correct correlation, as it were. So when interest rates are lower, that tends to promote lending or see faster lending growth across the Gulf economies. And when it's higher, the lending growth tends to slow. So that does at least suggest that those lower borrowing costs are feeding through into those economies. I think one of the things beyond just lower borrowing costs that seems to be a driver of lending growth and activity, particularly in the consumer side of the Gulf economies, is what happens with the oil price because of what that means to fiscal policy across the region, but also more broadly a sort of a sign of economic sentiment that when oil prices are high, it's normally a more fruitful period for the Gulf economies, that governments are able to spend more, how that ripples through the economies in terms of the non-oil sector as well. So coming alongside a period when oil prices are generally lower, that maybe the benefits of lower borrowing costs, lower interest rates aren't going to be as fully felt as they might have been previously, say when oil prices were above $80 per barrel. But nevertheless, there probably will be some stimulus to lending growth of those interest rates feeding through into the consumer side of Gulf economies.
And what about if, as a consumer, you're more of a saver than a spender? Do rate cuts mean lower returns on deposits and savings accounts?
Yes, exactly. So it will probably feed through into that side of the coin as well, where if you are a saver, you will have, if it's fully reflected by banks, that they'll reduce the rate on savings as well. So you will get a lower return. Part of that is the ultimate policy of the ultimate goal of policymakers in this is to incentivize spending to try and promote growth in the domestic economy. So as a saver, that if your returns are low, you might decide to take some of that money out and have that as spending money now, or you might seek to put it into something where potentially it's either more long term, where it's locked up for longer and might get a higher rate of return, or potentially putting towards something that's short term but slightly riskier, where you might get a higher rate of return.
Yeah, so it sounds like it's with the start of what could happen with the decision based on Wednesday, that it could be the early stages of consumers borrowing more, spending more, versus saving more from having the same amount of money. So maybe it's the beginning of the time to think about this is a time to get a mortgage versus keeping it in your bank account to accrue if that accruement is going to be less over the next maybe 6 to 12 months, would you say?
Yes, I think. I mean, it's probably the time to start thinking. I mean, when we look at financial markets in terms of what they're pricing in with Fed decisions, this decision this week is unlikely to be the last in terms of where they deliver future interest rate cuts. That there's probably at least one more priced in. So interest rates are likely to come down a bit further than what happens this week. So when you come to a decision or thinking about mortgages, it's at least something that's on your radar now, and then you can sort of the momentum at least seems in the direction of interest rates being lowered once again, and that making as a consumer the decision to take out a mortgage or borrow for personal reasons, like for a car, for example, that it might be more beneficial to do so down the line. But it's also something where policymakers have to consider that with they don't want to create a sort of negative spiral where people are waiting for that interest rate cut and waiting for things to be cheaper. Otherwise, you risk actually denting economic activity in the near term. But it's normally that it will start to drive activity now, and then as it starts to feed through more into the economy, that more borrowing picks up naturally, and then if another interest rate comes, that's the sort of next compounding factor to do so.
The thing is, I'm here in the UAE, and already people here are experiencing high costs when it comes to real estate and just the overall cost of living. So, could a weaker dollar from rate cuts, for example, affect imports to the Gulf, and how would that feed into inflation and the consumer's daily cost of living, for example?
Yeah, certainly a weaker dollar will have its impacts in terms of affecting the cost of living in the UAE, but also all the Gulf states that imported goods are going to be more costly relatively, and so that has its impacts in terms of inflation, how that feeds through. I think it is notable in the UAE, but also across most of the Gulf actually, that inflation, at least in the headline rate, is relatively weak. It's around the sort of the sort of 2%, but even below that in some cases. I think in some of the smaller Gulf states it's negative, and price pressures, at least from what we see from the inflation data, have been pretty soft and look like they will remain so. And but that's not to say that those costs that have risen, as you said about the UAE and its housing market, that's in quite an unbelievable run for the past sort of four years or so, that housing costs have risen by such a large level. That's fed through into rentals as well. So there will be some sectors within these economies where, not just because of a weaker dollar, but price effects will still be felt even if the inflation remains low. And I guess that if the dollar weakened by a greater extent and fed through in terms of those higher import costs, that would have a sort of more broad-based upside to inflation risk and the sort of cost of living across the Gulf states.
Yeah, exactly. There are other factors involved, but it is something that will help ideally bring costs down when it comes to borrowing and such. And of course, the Gulf's property market is of global interest. And with interest rate changing, do you see lower borrowing costs reigniting demand in places like Dubai or the UAE overall in the housing sector?
I mean, inevitably, that if it's cheaper to take out a mortgage, borrow for property reasons in the likes of the UAE, Dubai, Abu Dhabi, even beyond that in the rest of the Gulf, that probably does become an enticing prospect. I mean, while I said that Dubai's price, from the data we get of Dubai's residential property prices, they're still rising by at least sort of 13% year on year. Yes, that pace has been gradually slowing in terms of a year on year change, but the fact is that prices are still rising. So there's potentially still scope to get in while this bull run continues and sort of gain value within the market. So there's definitely scope for that greater demand, and also that, from data we receive reports from various sort of property related companies, that there's still new projects being built, that being both on a residential real estate front, but also commercial, hospitality. And then obviously, if you go beyond that in some of the Gulf of the really sort of big, massive sort of giga project things, that whether that does feed into it, of obviously the borrowing costs are lower, and that there's an opportunity for investment there. But I think there will be probably some sort of stimulus to demand within property sectors across the Gulf.
And for the final question, I wanted to get a sense of your outlook. So historically, interest rate cuts have been seen as early signs of a global recession, meaning that it's not one cut alone, and it's not always the case. But looking back historically, we've seen that in multiple periods from 2008 and other times ahead of global recession, that we have seen interest rates lower gradually. Do you sense that this time around, that we talked about what's happening in the next 6 to 12 months, but looking maybe at years down the line. Do you feel that we're heading that direction to the point, for example, where consumers should reconsider their spending if we're headed that direction?
I don't think we're heading towards anything like sort of 2008, and I don't think we're really heading toward a period of sort of global recession. I think this is more a period where interest rates are hiked, particularly in developed markets when there was the spillage of the war in Ukraine, what that meant for global sort of food prices, energy prices, where interest rates are hiked. And we're still in that period of coming back down from a period of higher inflation. So it's naturally starting to reduce interest rates. And I think there was some in some of the developed markets, some broader sort of stickiness to inflation over the past sort of 12 months where inflation didn't come down as fast as expected. But we're now in this sort of period where the US is starting to consider interest rate cuts again, with it all almost seems certain they will this week and will over the future. The Bank of England, for example, is it's sort of seems to be in a sort of one-off meeting rate cut sort of cycle. So we are in this direction. All central banks are still in a monetary loosening mode. It's just that it's maybe a bit more cautious than, say, 2 years ago when we were making forecasts that would have been the case. So I think what we'll see over the next few years is if this interest rate cuts continue to be delivered, it's not a sign or a bellwether of global recession. If anything, our forecast at Capital Economics is that global growth will sort of stay around its current levels, around the 3% mark over the coming years, and places like the US could see sort of slightly faster growth. And then how that feeds in, I guess, with some of our views with the Gulf economies, at least of our outlooks, is that we do see, I think, a sort of two-paced sort of path of growth across them. So the UAE, Qatar, Kuwait, I think, are the three where non-oil growth, so I guess trying to sort of exclude those factors of all the OPEC plus output hikes that are stimulating overall GDP growth. But if you look at the non-oil economies, I think we'll still see robust non-oil GDP growth across those economies because of the effects of stimulus when it comes to looser monetary policy by virtue of the feeding through the US Fed rate cuts and shadowing the Fed. But also that when we look at it in the UAE in particular, the tourism sector is enjoying a record year again after a strong 2024. Bank lending is already pretty strong. So if there is new impetus behind that with rate cuts, that could continue to sort of drive activity in the non-oil sector. But also that those three economies of the UAE in particular have the strongest balance sheets of running twin budget and current account surpluses where there's scope to keep fiscal policy supportive.
But just looking at also like Trump's tariffs and the state of the global economy at the moment, oil prices and that in combination, and then seeing that now is the time that interest rate cuts are being considered. That's what I meant in terms of like, do you see that combination of these developments taking place as the possibility that economic growth could slow based on your assessments?
I think there's probably, if we were to skew sort of any downside or upside risk, I think things are probably skewed to the downside because I think there is greater uncertainty in the global economy around tariffs and the impacts that's having not only with the US economy, but how that's splintering through of any pressure from other economies to put tariffs in place, if that's to have an impact on trade flows and impacts on their economy as well. But also that if this is a sort of the impact of tariffs are inflationary, that does potentially have its downside impacts of while we're saying that central banks are in a monetary loosening mode, if tariffs do have that inflationary impact of causing policymakers to not cut interest rates, the interest rates remain higher for longer, that inevitably removes some of the stimulus that could have been delivered. So yes, while we think things are sort of trending in the right direction, there's not going to be a global recession. I think the risks are probably skewed to the downside if there was going to be.
Great. Thank you so much, and we appreciate your time.
No problem at all, Salim.
Thanks for listening to this episode of Business Extra from The National. Make sure to check out The National's podcast wherever you stream. This episode was produced by our podcast editor, Duat Farid. Arthur Edison is our audio engineer, and I've been your host, Salim Essaid.